Welcome to this video. Today we will try to have an overview of Incotems. We will try to get an understanding of how Incotems will apply to or affect the international trade. What are Incotems? Incotems are international commercial terms. The latest version is Incotems 2020, published by International Chamber of Commerce. How it helps? It helps because they are standardized rules that clarify what are the rights and duties, what are the obligations of the buyers and sellers. It can be used for domestic trade or international trade. It can be used for sea as a mode of shipment, air as a mode of shipment, or by road. It will specify who handles the cost for, say, transport or insurance or customs duty. It specifies when the risk, that is the risk of loss of damage, will be transferred from the supplier to the buyer. It will also specify what tasks, for example like customs clearance, will be carried out by whom at which stage or port. So there are mainly 11 Incotems and they are split into categories called rules for any mode or rules for inland waterway or sea. Let us look at what are the rules for the sea or the inland waterway. Free alongside ship, FAS. Here the seller delivers the goods by placing it alongside the ship. No need to load into the ship, but he has to bring it to the port of shipment. The buyer will handle the loading cost and onward shipment on the ship. The risk transfers when you are placing it there. Then comes the free on board, FOB. The seller delivers the goods on board the ship at the port of shipment. That means the buyer will not pay for loading, but buyer will pay for all other costs from that point after the goods are loaded. The freight will be paid by buyer. The risk transfer happens when the goods are placed by seller on board the ship. Then it is a CFR, cost and freight. In a cost and freight situation, seller pays for the transport to the destination port, but the risk transfers the moment goods are placed on board the ship. The seller pays for the transport to the destination port. Risk transfers when the goods are placed on board the ship, but seller has to pay. CIF, cost, insurance and freight. Here the seller pays for the transport, seller pays for the minimum insurance. It is 110% if the LC says so, and then it will be paid up to the destination port. But the risk transfers the moment goods are placed on board the vessel. So these are the terms for water or sea transport. What are the terms that can be used for any mode of transport? The most popular term is EXWX works. That seller makes the goods available at their premises, maybe the factory gate. Buyer bears all cost for moving the goods from there. So keeping it at the nominated premises is the only requirement in X works. FCA, free carrier. This means a seller delivers the goods to the carrier or place nominated by the buyer. Seller delivers the goods to the place nominated by the buyer. The risk transfers when the goods are handed over to the carrier. Free carrier means risk transfers when the goods are handed over to the carrier. Here also, from the moment it is handed over to carrier, all the cost and the risk will be borne by the buyer. CPT, carriage paid to. Seller pays for the transport till destination, but risk transfer happens the moment goods are handed over to the carrier. CIP, seller pays for the transport and insurance to the named destination, but risk transfer happens the moment goods are handed over to the carrier, the first carrier, not any carrier, first carrier. Insurance continues till destination. Freight is not paid. In CIP, freight is not paid, but in freight in the sense freight and insurance are paid by the seller. In CPT, insurance is not paid, but freight is paid by the seller. DAP. DAP is delivered at place. Seller delivers goods to the named destination. It should be kept ready for unloading, not necessary to unload. Buyer will unload in a DAP. The risk transfers at the destination. In DPU, it will be delivered at the place and it will not be, the seller will have to unload. Seller will have to unload the goods at the named destination. Buyer manages import clearance. So when it is unloaded, it is DPU. Seller takes the responsibility. DAP means the seller does not take the responsibility for unloading. Both are at a destination. The next destination term is DDP, delivered duty paid, where seller not only unloads and delivers but also pays the duty for the customs clearance at the destination port. These are the various Incotems. Now let us have a look at the case study. Now suppose there is a US electronics company, retailer, TechTrend, and they are contracting the South Korean manufacturer KoreaTech to purchase 3 million worth of OLED screen for retail distribution in California, USA. The shipment is to move from Busan port in South Korea to port of Los Angeles in USA. Final delivery will have to be made to the warehouse in Los Angeles by late April 25. Two scenarios are explored and they have to decide which one to choose. One is FOB Busan, which is in Korea. Another is DAP Los Angeles, which is in USA. And then we have to understand which is better. Now, who are all the parties involved? Exporter seller is KoreaTech, importer buyer is TechTrend USA, freight forwarder is Pacific Link, customs authorities are South Korea Customs and US Customs. Banks are Wells Fargo Bank who issues LC. Insurer is Seoul Insurance South Korea. We have to compare FOB with CIF. FOB with DAP. Now scenario 1, FOB. How do we apply this FOB to this situation? In FOB, the seller responsibility is to deliver the screens on board the ship at Busan port by 25 March. The costs are production cost, inland transport cost, export clearance cost and loading cost. The documents required are commercial invoice, packing list, bill of lading and export permit. The risk transfers the moment seller puts the goods onto the vessel at Busan port. What are the buyer's responsibility? TechTrend has to arrange for and pay for ocean freight because it is FOB. They will pay from Busan to Los Angeles freight. They will arrange for US customs clearance. They will pay duties if any. They will arrange for inland transport at Los Angeles. The risk is from the point the goods are put onto the vessel in Busan port to the buyer's account. They will take the transit damage risk. The buyer will take that, and they will arrange for insurance. TechTrend will arrange for insurance for 3 million coverage separately. What is the transaction flow? On March 20, maybe the screens are loaded. April 15, the shipment arrives in Los Angeles. April 18, the goods are cleared in the customs. April 20, the payment will have to be made via Wells Fargo Bank because it is letter of credit at site. The challenge is that if there is a damage, because there are rough seas and up to 10% screens may get damaged after leaving Busan, the risk is transferred the moment goods are put on the vessel. TechTrend bears the loss and files the insurance claim, and insurance claim will take some time to come, so there is a delay. The outcome is that Korea's obligation ends at Busan, while TechTrend manages additional cost and transit risk. FOB suits the exporter by limiting the liability yearly. Now comes the second scenario. Second scenario is using DAP, delivered at place at Los Angeles warehouse. Now seller's responsibility is deliver the screen to Los Angeles warehouse. It should be ready for unloading on a carrying vessel or truck. The costs are not only production cost of 2 million but inland transport cost, export clearance cost, ocean freight cost, inland transport to warehouse and maybe insurance up to that place. Documents required are invoice, packing list, BL, transport document and warehouse delivery. The risk remains with KoreaTech till it is unloaded at the warehouse. Because it is DAP, till it is unloaded, the risk remains with the buyer. What are the buyer's responsibility? They will have to unload the goods at the warehouse. They will also have to pay for import customs clearance, import duties. The risk transfers when the goods are unloaded. Insurances, Korea opts for 3 million insurance coverage during the transit, but it is not required to be given to anybody, but at the sake of prudency it is required. How the transaction flows? Maybe by March 25 Korea ships the goods, April 15 the goods reach Los Angeles port, April 20 the screens arrive at the warehouse, April 22 TechTrend unloads and clears the customs. Now if there is a damage, the same storm damages 300,000 worth of screens, KoreaTech's insurance will cover it, and the risk stays with the seller until the warehouse, where TechTrend is unaffected. The outcome is that KoreaTech incurs 2.4 million in cost, managing transit risk, while TechTrend's cost dropped to 340,000 only because only customs duty and inward haulage is included. So DAP shifts more burden to the seller. So seller will have to price the goods accordingly. Now, how do we compare and understand these two Incotems? In FOB Busan, the seller's role ends in Busan. Buyer controls the shipping but bears the cost. Risk transfers when the goods are placed on board the ship. In DAP, the seller handles the delivery to the destination. It is ideal for TechTrend to avoid the shipping uncertainty and Panama delays. The risk transfers at the warehouse when the goods are kept ready for unloading. Key difference is that FOB shifts the risk and cost to buyer, while DAP extends the buyer's responsibility till the final destination. So Panama Canal congestion may cause a delay, and that may cause difficulty in getting the documents to be presented, etc. will be the problem the buyer might try to sell to the seller. Flexibility. FOB suits sea freight. Risk management. DAP protects buyers in volatile markets. Cost allocation. FOB lowers the seller's cost. DAP simplifies buyer budget. Other terms are, there is a CIF term, seller pays freights and insurance, or X works, buyer does everything. So different Incotems have different risks or roles to assigned to different parties. The conclusion is that the trade, when today being disrupted by logistics or geopolitics, choosing the right Incotem will help you align your roles and responsibilities. If the risk transfers by putting it on the ship, that is a good Incotem for the supplier. Thanks for watching this video. We shall meet again in another session.